Hey Bowtie Nation, Joseph Hogue here with another news update, quick video updates on the news that catches my eye. Today we're going to be doing an update on the entire cybersecurity theme. Okay, all the stocks I'm following in that. You know, it's one of my favorite growth themes here over the next decade. One of the best ones because, besides the all the excitement over AI, robotics, quantum computing, cybersecurity is the only one that's really been paying off for the last decade as well, and is one of those can't miss themes that we're following. We're talking about a 30% annualized return in the 5 leaders here, the 5 stocks that I've recommended on the channel. Here you see net Cloudflare up 410% over the past 5 years. CrowdStrike Holdings up 317%, one of my favorite ones in the space. We'll get to that one here pretty soon. All of these up more than 100%, but Okta clear down at the bottom, down with Sentinel, which I follow Sentinel, but it hasn't done anything for 5 years. But Okta, probably the biggest opportunity there. We talked a little bit about that in our Tuesday update video. I'm going to go back into those numbers for you because this is one of the biggest opportunities in cybersecurity right now. Against that, though, the reason why I wanted to do this update, because we are seeing a real weakness on a few of these stocks into earnings. A few of the companies, especially Palo Alto Networks, reporting earnings that missed expectations, saw their stocks dive on that, and it's really pointing to a slowdown in IT spending for some of these names. So I wanted to update you on the news around these cybersecurity names, the long-term growth prospects of these, and really which stocks I'm buying right now. And here, the reason why this is my favorite growth theme over the next decade is because besides that 30% annualized return we've seen in a lot of those stocks, this is still projected to post 12% plus industry growth, and even better in some of the segments that we'll look at, but 12% annualized growth across the industry. And what's even more important, this is one of the areas of IT spending that just cannot be cut. We can see here that ransomware attacks hit 72% of the largest firms hit last year, okay, 59% overall. More than half, almost 2/3 of organizations were hit by ransomware attacks last year. And when the average cost of each one of these ransomware attacks is $5 million, and some of these into the hundreds of millions. Okay, Clorox, $356 million, estimated cost of that breach, up to $1 billion for the United Healthcare breach when they got hit by ransomware themselves. When the average cost is $5 million, you cannot afford to cut out on your cybersecurity spending. So when we see these cybersecurity stocks take a hit on these earnings, on this short-term earnings weakness, like we saw with Palo Alto, like we saw with Fortinet, it doesn't worry me at all. In fact, I see it as a buying opportunity, okay, because we are still going to see that steady 12% plus growth across the industry. We're going to see even faster growth within the various segments that we're going to look at. So it is really going to be a buy the dip opportunity here for cybersecurity, one of my favorite growth themes. Really exemplifying that dip, Fortinet, ticker FTNT, plunged 23% last week on its earnings that really showed that key fear in the market. And while Fortinet did report solid earnings and sales for the quarter, beating expectations, the disappointment really was in this product refresh cycle. Okay, it's been transitioning customers into a new product cycle, into an upgrade cycle. The earnings or the sales reported off of that weren't as strong as analysts believed they could have been. And the company said it's about 40 to 50% through that upgrade cycle. So that means, at least half of its customers have already switched into the new product, have already presumably are paying those higher prices. So, if that pricing power isn't as high as analysts think it should be, it's really showing that a lot of clients are maybe putting that upgrade off. The pricing power is not as strong as hoped. So it's leading to revenue growth worries here. Now, looking at expected revenue growth by segment. Okay, so again, the entire cybersecurity industry forecast to grow at about 12% annually. That really hides strength and weakness in individual segments here. And we can see that firewall segment in which Fortinet plays only at about a 3 to 5% annualized growth. So it is the legacy segment here for cybersecurity. It is much lower growth. So that's not surprising that's where the fear is in Fortinet, that this growth isn't as strong as even these forecasts are, and that's why it hit the stock. But then when we look at the stats here on these 7 cybersecurity stocks that we follow, we do see that Fortinet is the second cheapest here on a price to earnings as well as a adjusted for growth basis. Okay, 31 times price to earnings, just 3.7 times of price to earnings to growth. That is only bested by Okta here, which we're going to talk about later. But price to earnings of 31 times on that price to earnings basis, the second cheapest here. And you can see that revenue growth is not the best here. It is, again, the second worst revenue growth here among the 7 stocks, 12.6%, really blown out of the water by CrowdStrike, by Zscaler, by Cloudflare, which we'll talk about those. but really kind of subpar revenue growth, but actually kind of impressive when you consider that the entire segment, that firewall segment, is only expected to grow 3 to 5%. So they're actually leveraging that growth up into 12.6% revenue growth. We can see the strength here with Fortinet, 31% operating margin. Okay, so you've got all these other companies that are spending so heavily in research and development, in staying ahead of those high growth competitive segments. Here you've got Fortinet that is just a cash machine, converting 31% of its sales into operating profits because there is relatively less competition here in this firewall space. It's dominating that theme, that segment. So, it is really just the big fish in this little pond of firewall and hardware security. So instead of just looking at that growth, you really need to look at the whole picture here. And if we look at the segment leadership here, so we know the segment growth rates, we know that firewall is the slowest growth rate. But if we look at competition within that sector, we see why we still want to focus on Fortinet, okay? Even if it's only got a 12% revenue growth target, it's got that operating margin of 31% because that profitability is unchallenged here, okay? If we look at these, if we go to Fortinet here, it has got the dominance there in that firewall segment. And really within that segment, only Palo Alto Networks, which pretty much competes in every segment, but only Palo Alto Networks really has a product in that. So firewall on-site premise hardware, Fortinet has that locked down. And that's why it's a cash machine here at 31% operating margin. Also want to talk about Palo Alto Networks. Sold off on its CyberArk acquisition news. Hasn't reported earnings yet. It's going to be reporting here pretty soon next week on the 18th. Could also be a candidate for a sell-off on those earnings, but really sold off this 9% here on the news that it was acquiring CyberArk software for $25 billion. Palo Alto Networks buying CyberArk security for a little higher exposure to that identity and access management segment, a little bit slower growing segment, but absolutely critical to your product portfolio. Here we do see projected revenue growth right around 9 to 12% for this segment. Again, the overall industry expected to grow about 12%, but that really hides the strength and weakness in some of these identity and access management. So your first line of defense for cybersecurity firms expected to grow between 9 to 12% a year. Researching this further, you will see different estimates. For example, Morgan Stanley here has the IAM growth at a faster 18% pace, which would be a solid pace for revenue growth, pace to $48 billion just to 2028. So strong pace there, according to Morgan Stanley. And really very little competition here. You've got Microsoft with the market leader at 30% of the pace, but for pure play cybersecurity firms, you've really only got Okta there at 11%. Okay, you can see CyberArk has projected right around 3% market share with its 10% or 10,000 customers. Okta here with double that, 20,000 customers, has about 11% market share within this identity access management. You can see that shares of CyberArk software popped 15% on that news, already at 50% over the year. But really, like we did on Tuesday, putting two and two together, these news stories as well as the industry research took me to that Okta and what I think is going to be the next big potential takeover target. I am going to cover my favorite cybersecurity stock next, but if you've ever wondered what's in my portfolio or just want to see the stocks I'm buying, you can now by joining me on the Blossom Social Investing app. I just started using it a couple of years ago. Love the app for getting ideas and sharing my own portfolio. And I know this isn't just another social investing app though. You can connect your brokerage account or just put your stocks in manually to track all your stocks in one place. You're going to see insights like portfolio percentages, average dividend yield across the entire group. You're also going to be able to join more than 300,000 investors in the social feed to see what everyone else is talking about, what everyone else is buying. I've shared my portfolio on the app. It's totally free to download, so look for the special invite link I'm going to leave in the description and check that out. Now, besides the potential in those shares of Okta as a takeover target, my favorite here, really CrowdStrike Holdings, up 78% over the last year. CrowdStrike leads in the kind of agentic AI, artificial intelligence for cybersecurity that is really going to be the next wave in cybersecurity and really going to take a lot of that market share because it can do so much, tacking on those AI products within its platform. The company's conversion to its Falcon Flex platform is going very well. About 60% of its users have shifted, cross-selling them into multiple modules. And you see here, while CrowdStrike doesn't have a product in every segment, okay, like Palo Alto, it doesn't have that breadth of products across its portfolio, across its platform. You can see that the segments it does compete in, it is a leader in, and those are the high growth segments, okay, so cloud security, endpoint security, the SIEM analytics, and especially that AI agentic security. all the segments that are growing faster than the others. Here we do see CrowdStrike Holdings second best revenue growth at 21.6% revenue growth, tied with Zscaler there. Second only to Cloudflare with its 26% revenue growth. And of course, that 20% plus revenue growth, what we like to see in these growth stocks, in these themes, but very strong 20% plus year in and year out. Now, what this 6% negative operating margin, typical of these cybersecurity companies that are really reinvesting into that research and development, trying to grow their platform, trying to stay competitive in this very competitive field of cybersecurity. So that's not optimal, but of course, you can't fight that 78% return over the past year. You can't fight this 400% return over the past 5 years. Now, what I will say is, that is part of the reason why I like some of these others, these Palo Alto Networks, the Fortinet. While it has slower revenue growth, 12, 14% revenue growth, they are cash machines. Okay, Fortinet converting 31% of its sales into operating margin. That's why I do own shares there, as well as Palo Alto, which is only 14% revenue growth, which is respectable, double-digit revenue growth, but also profitability at 11% operating margin. Of course, the laggard of the group, down 53% over the past 5 years. Okta, talked about this on Tuesday. Want to reiterate it a little bit here because I think this is the undiscovered opportunity here against that announcement by Palo Alto that it would be acquiring CyberArk for $25 billion. Again, in our segment forecast, we do see that identity and access management, a little bit slower growth, 9 to 12%, not bad, into those double-digit growths, but not the 15 to 18% growth we see in cloud security, not the growth we see in agentic AI. So it isn't having, investors just aren't screaming for the shares like the others, but it is a necessary part of your product portfolio. You need exposure into this for your platform to draw in the customers for every part of that platform. And again, with that slower growth, you really just don't have the competition in this segment, in identity and access management. Really only Okta and Palo Alto competing in that with the 10,000 from CyberArk software. Palo Alto does get a refresh of customers that it can cross-sell into its other segments. It does get a little bit more market share, that 3% market share from CyberArk software to add on to its own market share, but it is nothing like Okta has with that 11% market share in the IAM segment, the 20,000 customers that Okta has in this segment. So if we just put the numbers together, just put 2 and 2 together like we did on Tuesday, I want to reiterate it here because I think it is such a great opportunity for investors in Okta. If we look at this, I think an upside of 70% on a potential takeover target here for Okta. If we look at this, we've got 37 analysts forecasting $1.3 billion in sales for CyberArk software this year. If we do the numbers here, Palo Alto Networks offered $25 billion for those customers, for the $1.3 billion in sales. It's about a 19 times price to sales valuation for that stock. Now, if we go in here to the analysis for Okta, we can see $2.86 billion in sales expected for its 20,000 customers in that same segment in identity access management. Okay, twice the number of customers, more than twice the amount of sales expected, $2.86 billion. And if we just play around with the valuations here, okay, so Palo Alto paid $25 billion for the $1.3 billion in sales this year of CyberArk software. That is about a 19 times price to sales. If we apply that 19 times to the $2.86 billion in sales expected for Okta this year, that is a $54 billion market cap. Okay, we see here trading right now for $16 billion. If we do that 54 divided by the 16 billion current valuation, that is 239% return. That is more than 3 times your money here. That would be a share price of $305 for Okta. Now, you see here, it's only growing at about 6% a year, growing those sales about 6%, trading right now at about 6 times price to sales valuation. So I don't think there's any way in hell anybody's going to come in here and offer 19 times price to sales valuation for this company. I do think somebody makes an offer. I do think somebody needs to make an offer as you see that consolidation in this segment. In identity access management, somebody's going to have to snap up these customers so it has a competition against Microsoft, against Palo Alto Networks. It gets those 20,000 customers. They're not going to offer 19 times, but even if they offer 10 times that price to sales, so 10 times that $2.86 billion, $28 billion $28 billion sale price for shares of Okta here, divided by 16 where it's trading at now, that is a 78% return. That is 78% return on this if they get a buyout offer at that 10 times price to sales valuation. But then if we just look at the stats here, it doesn't really even need that acquisition to be a good investment. Okay, it is trading the cheapest among the 7 cybersecurity stocks here, just 32 times price to earnings. It is the slowest growth, 9.7% growth per year. That's still almost solid 10% revenue growth for a company. 0.9% operating margin. That's what I like here, right? It is slower growth, but they are profitable on an operating basis. They aren't investing quite as much back into the expenses, research and development, like a lot of these companies are that are unprofitable. So you do have a profitable company here growing at almost double-digit revenue growth and trading for a price to earnings that is a third what CrowdStrike Holding is. That is half of Palo Alto Networks. So you've got a real case for being an acquisition target that could send the shares up 78% and higher on this. But you've also got the case for just a good value stock in a growth theme. Don't miss our Monday market update, 9 a.m. Eastern before the market opens for the stocks I'm watching this week. Check out the most recent Monday's video here on the right. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.